The Little Book That Beats the Market by Joel Greenblatt is one of the simplest and most effective investment books, explaining how anyone, even without financial education, can outperform the market. The author, a successful hedge fund manager and business professor, has developed a unique method that helps identify profitable yet temporarily undervalued companies using just two key metrics. The simplicity of this approach makes it accessible even to beginners, yet it has proven its effectiveness in practice, delivering returns far exceeding the S&P 500 index. Unlike other books that either focus on investment psychology or propose complex analytical models, Greenblatt provides a clear, mathematically justified formula that allows for consistent results. The book has gained immense popularity due to its practical approach. It does not require deep economic knowledge, but offers a powerful tool for building long-term wealth. This is why The Little Book That Beats the Market has become essential reading for private investors who want to manage their money wisely and achieve sustainable capital growth. Greenblatt begins the book by explaining the problem most investors face. They lose to the market because they make decisions based on emotions rather than analysis. People buy stocks of popular companies without considering their real value or act under the influence of short-term news. As a result, they make common mistakes, buying high and selling low. To illustrate how the market works, the author introduces the character of Mr. Market, an imaginary figure who offers investors stocks at different prices every day. Sometimes Mr. Market is overly enthusiastic and overprices stocks. Other times, he is pessimistic and sells them too cheaply. But a wise investor does not fall for his emotions and instead evaluates stocks based on real business metrics. This is where the magic formula comes into play. It consists of two key criteria: earnings yield and return on capital. The first metric shows how cheaply a company is trading relative to its earnings, while the second indicates how efficiently it uses its assets to generate profit. Together, these metrics help identify companies that are both profitable and undervalued by the market. Greenblatt explains that his strategy is based on calculations, not guesses. He provides historical data showing that companies selected by his formula consistently deliver higher returns than the overall market. For example, over 17 years of testing, the strategy yielded an average annual return of about 30%, significantly outperforming the S&P 500 index. To prove the method's effectiveness, Greenblatt provides real-life examples of companies that were undervalued at different times, but then saw their stock prices rise sharply. For instance, in the early 1980s, Ford's stock was cheap because the company was struggling, but after restructuring and smart management, its stock price increased several times over. A similar situation occurred with Apple after the 2008 financial crisis. Many investors panicked and sold their shares, but those who followed the formula and bought at the dip eventually saw exponential returns. Greenblatt emphasizes that the key to success is not predicting the future but following a systematic approach. His strategy helps find companies that are temporarily undervalued due to emotional market behavior, but whose actual value is much higher. He provides examples of how his fund has used this method to consistently outperform the market, proving that disciplined adherence to the formula helps investors avoid the common mistakes that most people make. Greenblatt explains why his strategy does not require complex calculations. He says that investors should select 20-30 stocks annually that meet the magic formula criteria, buy them, hold them for a year, and then review their portfolio. This eliminates the need for daily market monitoring and reduces emotional influence. He shares an example of an investor who decided to use his method. In the first year, his portfolio saw a small decline, but after 3 years, it delivered over 100% returns as the stocks selected by the formula rebounded and grew. Greenblatt also recounts how he taught his students this strategy, and many of them achieved remarkable success. He explains that even if the formula underperforms the market temporarily, it inevitably surpasses it in the long run. Greenblatt also emphasizes the importance of understanding the difference between price and value. He explains that a stock's price at any given moment reflects not its actual worth, but merely the market's current sentiment. This is why great companies' stocks can be cheap during times of panic, while weak companies may be overvalued during market hype. He provides examples of companies that were trading significantly below their fair value at certain times, but then saw their stocks soar as the market recognized their true worth. For example, he discusses IBM, which remained a stable and profitable business for many years, but was periodically undervalued due to short-term investor concerns. Those who followed the formula were able to buy shares at a discount and earned significant returns when the market corrected. The author highlights that most investors make the mistake of focusing on short-term news and trying to predict price movements instead of analyzing a company's fundamental value. Greenblatt also discusses an important question. Why doesn't everyone use the magic formula if it's so effective? The answer lies in investor psychology and the structure of the financial industry. Many people struggle to follow a long-term strategy because they expect quick results. If a portfolio underperforms for a year or two, they become impatient and abandon the strategy, even if historical data proves its effectiveness over time. Greenblatt explains that professional money managers face even greater pressure because their clients expect them to outperform the market consistently every quarter. If a fund experiences a few bad months, investors often withdraw their money, forcing managers to chase short-term gains instead of following a sound long-term approach. This creates an environment where most professionals do not use methods like the magic formula because they require patience and discipline. However, individual investors have an advantage. They don't have to report to clients or meet quarterly performance targets. They can afford to think long-term and let the strategy work as intended. Greenblatt emphasizes that this simple ability to stay committed to a tested formula can give private investors an edge over even the most sophisticated Wall Street professionals. He compares investing to dieting. Success comes from consistency, not from constantly switching strategies whenever results temporarily decline. The book also explores practical considerations, such as diversification, risk management, and tax efficiency. Greenblatt advises investors to own 20 to 30 stocks that meet the formula's criteria, as this level of diversification reduces risk while still allowing for strong returns. He explains that while some selected stocks may underperform or even decline, the overall portfolio benefits from the strong performance of other stocks, ensuring that the strategy works in aggregate. He also touches on tax strategies, such as selling losing stocks at year-end to offset taxable gains, a technique known as tax loss harvesting. He discusses how the magic formula can be adapted to different markets, including international equities, though he warns that results may vary in emerging markets due to different market structures and regulations. Greenblatt acknowledges that while no strategy works perfectly all the time, historical data suggests that sticking to this method provides a far greater chance of success than attempting to predict market trends or relying on investment advice from media sources. The book ultimately serves as both an investment guide and a behavioral finance lesson, teaching readers that the biggest challenge in investing is not the strategy itself, but having the discipline to follow it through market ups and downs. Greenblatt concludes the book by reminding readers that his method does not require guessing which stocks will rise, but relies on rigorous calculations. He asserts that anyone, regardless of experience, can profit in the stock market if they follow the strategy and avoid emotional decision-making. He stresses that investing is a marathon, not a sprint, and the key is to stick to the system rather than try to predict market movements. Thank you for watching. Subscribe to the channel, leave a like, and share your comments. Share this video with friends so more people can learn how to invest wisely and build their financial future.